This is the Resilient Advisor Show. My name is Jay Coulter, and joining me for this episode is Michael Gayed, and we're going to talk about portfolio positioning for financial advisors as you head into 2021. Michael Gayed is the publisher of the Lead Lag Report. He is one of the co-founders of the ETF think tank and a well-known portfolio manager on social media. Earlier this year, right before the election, Michael came on and gave the perfect prediction. It does not matter who wins the election. It was one of the most viral clips we had of the Resilient Advisor show this past fall. Michael, I think it helped a lot of people as they were thinking about their portfolio positioning heading into the election. Today, we're going to focus, what do you do heading into 2021? So I want to start with a clip from a recent guest that I had on the show, Lenore Hawkins, the chief macroeconomist at Tematica Research.
The only thing that's really keeping this economy in positive growth is actually the stock market.
What do you think about her comments?
Depends on which economy. Right, if you're talking about the economy for the billionaires and the asset holders, yeah, it's a hell of an economy, right? One of the greatest economies since the 20s. For everybody else, not so much. It kind of goes to that K-shape kind of argument about what's happened coming out of COVID. Look, one of the things the Federal Reserve has been very open about is them trying to push asset prices higher in the name of the wealth effect, under the idea that as stocks rise in value, as homes rise in value, there's a there's a mechanism there for people to feel like they have more money, to have them spend more, to create inflation, to create growth. The problem is more and more the world is being divided between the asset holders and the income holders. The income holders really don't have any income to hold given where yields are. So I would be a little bit more careful, I think, personally, in terms of sort of thinking about this idea that we're in this boom economy. It's not a boom for a lot of people that are suffering out there.
Yeah, and that's true all over the world, right?
Global phenomenon, right? I mean, it's remarkable, right? This one of these things I kind of have been ranting on is this idea that you can't argue that for stimulus at the same time as argue that we have to stop this wealth gap from widening, because there is a direct link. In the midst of the pandemic, when all the talks were coming out about stimulus checks at $1,200 going out to households, I made the case that, I'm sorry, that $1,200 is going to be nowhere near what asset values will increase in value by. So it only then widens the wealth gap. And every single iteration of stimulus, even though it's done in the name of economic growth, the reality is it's done in the name of very wealthy asset holders who directly benefit from it. And when you really think it through, even if you were to say, well, let's tax all these very wealthy billionaires and ultra millionaires who benefit from this asset price inflation, well, you tax them to give that money to everybody else. What's everybody else going to do? They're going to go back and go on Amazon and spend that stimulus. It's going to go right back to the billionaires and the ultra millionaires. So, it's a strange dynamic to think that we're in this kind of sudden growth economy when unemployment is still so high, and when you have a lot of people that are basically just struggling to make ends meet.
Yeah, if you're watching this live on LinkedIn, Twitter, Facebook, or YouTube, and you want to ask Michael a question, just post a comment and it flows through to the studio, and I'm happy to pose it to Michael. If you're on Twitter and you're not following Michael, you're missing out. Michael, earlier this week, you had posted some stuff about the Shiller PE ratio. Given the things that we're talking about now, as it relates to just fiscal inflation and the economy struggling, do PE ratios matter? And what does a financial advisor do when constructing a portfolio when looking at this chart?
You always got to be careful in saying valuations don't matter, but in a world where everything is manipulated by central banks, I can make the case that valuations don't matter at all. And even though the Shiller PE is basically in bubble territory, we know bubbles can persist for a while, especially when you've got a printing press. So I don't know. I don't know if valuation matters as much. I do think there is a general move towards value as a style, as opposed to a metric, from an asset allocation perspective. But listen, the markets have been disconnected from the economy for a long, long time. This is kind of the most extreme that we've seen it, I think, ever. But when you look at, even beyond metric like this, if you look at just market cap to GDP, same kind of finding. You're pretty much at all-time highs. You look at leverage, all-time highs. I mean, everything's kind of related because the only way you keep the bubble from deflating is by re-leveraging more and more, blowing more into that bubble, and just try and kick the can down the road until the can finally kicks back, and it will at some point.
God, so Michael, when was the last time the economy was aligned with the markets? When could you say that there was a good way to extrapolate what's going on in the economy to the stock market?
March.
Oh man, people are going to think I set you up with that question. Actually,
no, but it's true. That's valid. I've been tweeting this out forever, right? It's the greatest depression, most bullish depression in history.
All right. So prior to March this century, had there been periods of time where the economy was in sync with what we were seeing in valuations in the stock market?
Yeah, I mean, probably coming out of the tech wreck would be kind of the most, I think, recent example in terms of cycles. A lot of things got very distorted on the financial crisis and then all of the QE that the Fed did. I mean, and it's kind of the thing with the Federal Reserve, right? The Fed was created to manipulate the markets. The Fed was created in response to the banking panic of 1907. Or banking crisis of 1907. So what happened is Federal Reserve is designed to try to stabilize markets. Okay, so they do that by lowering rates, creating more leverage, and trying to just liquefy the system. Well, they've always done that. They've always manipulated the markets. It's just they've never manipulated to the extent that we've seen when they started doing all these asset purchases, expanding the balance sheet and QE. And that's not ending anytime soon. So something did break, coming out of the financial crisis in terms of a lot of these relationships, a lot of the dynamics of the relationship of capitalism, democracy, what the Fed does, all these different things that we talk about, every single day.
Yeah. So talk about a period of disconnect. The late 1990s during the tech IPO, I came across the Renaissance IPO ETF, threw it into my Y Charts account, and look at this thing. Does this look like the late 90s to you?
I'll tell you in 3 years. I mean, it's very possible, right? The reality is, look, there's been this unbelievable mania going on, right? And I haven't looked at the constituents of the ETF in a while. I assume there's a lot of tech names that are probably come to market on that, right? Again, mania can be manias for a while. Overbought can stay overbought for a while. It's probably very reminiscent of the 90s. But remember, I would use this example. Greenspan said irrational exuberance in 1996. He was right, but he was wrong in terms of timing because it was 4 years early, right? So yeah, you could be in this unbelievable IPO, and you're seeing some of this SPACs too, this kind of mania that's happening. That's not to say it can't continue. It just means that we're in this kind of, I think, more dangerous phase where if you miss it, it looks like you're going to suck. If you participate in it, you have liability.
Yeah, and as a portfolio manager or a financial advisor, you're in a spot. It's almost like you're darned if you do, you're darned if you don't have some type of plan to execute on it. What is your advice to the financial advisor that's building their own portfolios?
Yeah, FOMO is real. It's also the worst thing possible. Look, it's funny, right? In this business when you go up, if you're not up as much as the market or up more, people, your clients think, well, why am I giving you money? Why are you managing my portfolio? So you end up getting fired for underperforming. When you go down, though, you can say, well, I went down with the market. The market went down, right? So you have this kind of interesting double standard, the way that advisors interact with their clients. I think management forever will be the only thing that matters. That means don't get sucked into the retail mentality of chasing higher highs. Focus on trying to avoid the lower lows when they occur, and they will occur, I promise. It is not a matter of if, but when. It may be coming sooner than we think because all of the bullishness is so extreme now. It's funny, you've got the opposite of the pessimism extreme in March. Now you've got extreme optimism. Nobody was optimistic in March. Everyone's so wildly optimistic now. That seems like an interesting kind of mindset to kind of flip to for how to position next year. Yep.
All right. So one of your properties and organizations you're a part of is the ETF Think Tank. You guys have a show tomorrow. Tell us a little bit about it. And listeners, I will post a link to sign up in the comments.
Yeah, no, I appreciate that. So Think Tank Exchange, it's kind of weekly podcast we're trying to put out there, where we're trying to connect advisors to issuers, sort of the bridge between the vehicles and the drivers themselves. We got several guests coming on tomorrow. Going to be talking about some interesting topics. So do feel free to check it out, and obviously check out Jay, who's got a fantastic show here as well.
All right, we have our first question from Twitter. Mark Welsh asks, vaccine potentially pumping up the optimism. What are your thoughts?
Yeah, I mean, I feel like we've been doing that every week with some kind of headline on these vaccines. It used to be the idea that you buy the rumor, sell, and use. Now you just buy everything. Look, I don't know. Look, my general default with all this stuff is it's always harder and more complicated than people think, as a general default, right? With most things in life. So you get the vaccine. It seems like you still need to have a lot more time to see how long it lasts, from everything I've seen. I don't know how the public is going to respond to the vaccine in terms of people getting it. I put a Twitter poll the other day. It's actually consistent with national polls, asking my followers, when would you get a COVID vaccine? And the three choices were ASAP, after a few months, and never. And the responses were a third, meaning a third of people said they'd get it right away. A third of people said they'd wait a little bit. A third of people said they'd never get it. So again, I keep going back to, I think this is going to take more time than people think. So I don't think it is the cure, right, to this idea that the market is going to keep going higher, and that should be where optimism is put. If anything, the optimism may be that people are going to be taking to the vaccine more than maybe is going to be the reality. And that actually could actually send stocks lower if that's the case.
Yeah, I have found the same thing in my network. It's about a third, especially skewed towards the people who would take it now are the folks most at risk. The folks at least at risk don't really have an interest in taking it, or they want to wait and see how it plays out. To your point, Michael, I don't really see how that's going to impact the stock market, because it seems to be their external drivers driving price and not the economy like we spoke about before. And I just don't know that the correlation there matters.
Yeah, I think that's right, and it's always the thing that's not obvious that drives the markets higher, right? So it's not the old stories; it's the new stories that come after price has already moved, right? Because narrative always follows price. So I don't know. I would not view that necessarily as a bullish catalyst. I mean, the catalyst right now is probably just seasonality. The fact that bonds are probably have to start selling off, and there has to be a reallocation away from fixed income into equity. Why? Because inflation expectations are meaningfully rising. That's more of a bigger source of anything than I think any vaccine uses.
All right, before we get into the rapid fire rounds, let's talk a little bit, or tell listeners and viewers a little bit about the lead lag report and what they'll experience signing up.
Yeah, no, I appreciate that. So it's a premium research service that's designed for those that understand that if you want to kill it in the stock market, you have to not get killed. It's not one of those research services that's designed to tell you what hot stock or what hot theme. It's much more about managing those tail risk events and how to get ahead of them using award-winning white papers that I put out over the years. And I'm not just some guy that kind of says that haphazardly. I'm not just a research guy. I'm a fiduciary. I run the ATAC rotation mutual fund, which is up north of 60% this year, risk on, risk off. Also run the risk on, risk off ETF, ticker RORO, which also does sort of all-in rotations into equities and treasuries. I am obsessed with downside risk. That's why this year has been so phenomenal for my fund's performance, and so good for those that have followed the research. The people will be reminded again that risk off matters. The problem is they'll probably be reminded when it's too late.
Exactly right. I'm 47 years old. I've been around long enough to know that is the absolute truth, especially for financial advisors that want to be in business on the other side of a market correction. Michael, let's go lightning round and we'll wrap this up. You ready? This is through the lens of what financial advisors and portfolio managers should be thinking about as we head into next year. All right. Contrast your thoughts on gold and Bitcoin as an allocation in a diversified portfolio.
I think both fit because the correlation is low and because you don't have any other diversifiers beyond stocks and bonds like you used to.
It's a reoccurring theme on this show. All right, let's talk about value versus growth.
We've been waiting forever for that rotation to occur. This may finally be the start of it because part of this reflation, excess inflation idea is steepening yield curve, which benefits commodities, and I think they're going to run conceivably in a big way. Financials, energy, materials. Tech is the most overhyped story, which makes me contrarian on the sector's prospects. And that's why growth, I think, is probably going to be weaker, because tech is really growth.
As an aside, what type of trend would you like to see in value to confirm that the rotation has happened and you should have a bias towards it in your portfolios?
So I put out this report on the lead lag report called the leaders and laggards. So if you see on a continuous basis those sectors which are most tied to value, meaning again energy, financials, materials, if you see continuous yield curve steepening, you see continuous dollar weakening, which is happening. Value is very much tied to reflation hope. Growth is very much tied to disinflation, because tech is a driver of disinflation. So if you see that kind of sector sort of agreement happening, which is happening here, rather than these kind of short-lived one-off, disconnected types of moves, I think if that persists for some time, then it's probably real.
The biggest thing I see in advisors' portfolios is they miss out on allocations to the international space. Now, I don't blame them. It hasn't really helped their portfolio for the past 2 decades. What should advisors be thinking about today as we head into 2021 as it relates to allocations to international versus domestic?
I don't think advisors recognize how much concentration risk they are taking if they don't have international, because most advisors, correctly so, have been largely overweight U.S. equities, which probably means they're largely overweight large caps, which probably means they're largely overweight 5 stocks, right? So I'd actually argue that the only way to try to counter that in a market capitalization-driven world where the U.S. has been the only game in town, the only way to diversify is to go into those areas which did not do anything, which are the international plays. And listen, especially with emerging markets, it's been a long time since we've seen a cycle that favored them. I've been wrong many, many times thinking that finally the time would come for emerging markets to run. If commodities do run, if you see kind of global infrastructure spending, if you see the dollar continue to weaken and reflationary hope persist, yeah, emerging markets could finally move. And especially under a Biden presidency, you remove some of these tariffs, you're going to start seeing some new highs there.
Excellent. Michael, thank you so much for coming on. It's always fun to interview you because I can throw anything at you and you've got an opinion on it, and you're a great asset to the advisor community. Thank you so much.
Thank you. Appreciate it.